Craig Livingston, Managing Partner, Exact Capital Group. Neil Freeman, Principal of Aries Capital. Keith Oltchick, Chief Development Office of Remington Hotels. And Sherina Hosein, Principal of PSGN Capital Partners.
Quiet.
I'm just going to say it.
Your mic.
All right.
Yeah.
No more jokes.
No more jokes.
Okay, everybody, let's take our seats, if you will, please, so we get started. Respect others' time here. All right. So, good morning, everybody. My name is Mitch Miller, and we have a terrific panel this morning. And when I'm going to tell them how we're going to break it out in a couple minutes, but I want everybody to get a chance to introduce themselves. So, our panel is specifically directed to how to find equity, debt, or joint venture partners, and why would an investor fund your project? So that's what we're going to focus on this morning. And starting off with Craig at the far end, Craig Livingston, please introduce yourself. Tell everybody what you're doing, and why you're here, and we'll
All right, good morning.
down the line.
Thank you. Good morning, everyone. My name is Craig Livingston. I'm the managing partner of Exact Capital Group, which is a vertically integrated real estate concern. We own, develop, and build for our own account. We have a portfolio comprised of a lot of multifamily, about 3,000 units across the country, but we also do have hotel assets, our primary one being the Renaissance on 125th Street in Harlem, adjacent to the Apollo.
Wow. Love that. Okay.
Good morning, Keith. Good morning, Keith Oltchick. I am the Chief Development Officer for Remington Hospitality. We are a management company based out of Dallas. We currently operate about 120 hotels, have another 16 hotels under development, all with capital partners. We operate domestically as well as into the Caribbean and Latin America.
Just quick, is it third-party management, or is it for Remington's hotel portfolio?
So historically, Remington was, managed for the Ashford companies, and as of today, we're about 70% third-party and about 30% owned assets. Yeah.
Gotcha. Okay. Sherina?
Yes, I'm CEO and founder of PSGN Capital Partners. I work with sponsors and developers to help position themselves to attract the right capital partner, whether it be JV, equity, or debt. Additionally, I'm developing a platform with my colleagues, an investment platform across different real estate asset class, but we are concentrating on hospitality at first. My background is in investment banking, private equity. I work with a project developer in the EMEA region, so my experience is quite international. My clients right now, I advise on cross-border transaction, and I have about $2.5 billion in transaction experience, and I think that those skill sets, have augmented me to create my own company.
Okay. Neil?
Hi, I'm Neil Freeman. The job that most people know me about is a company I started 35 years ago called Aries Capital, LLC. We've done about $10 billion of financing, mostly debt, some equity, mostly throughout the United States, but also the Caribbean. But I also have been partner and owner of a lot of different real estate assets around the U.S. and some Caribbean countries, including Anguilla and Nevis. On the hotel front, I've owned properties in Chicago, Florida, New Orleans, including the largest one being the Waldorf Astoria in New Orleans called the Roosevelt.
Okay, good. And I've known Neil for many moons. So, especially when he took me to a Cubs game, and I being a Giants fan.
You won.
We won. We pitched a shutout that day. So anyhow, what we're going to do today is, it's very difficult to wonder, what are we looking for? Equity, debt? What is the specific kinds of projects? So what I want to do, panel, is we're going to kind of break out I guess we have about 45 minutes. So I want to break it out into 3 different projects, if you will. And then we'll try and capitalize those 3 different projects because that's the only way you can really do this, I think. So I'm going to take one project to be, I want to start off with the smallest one. And I think because we have a lot of potential new entrants into the industry here, that's maybe the most relevant for them. So I want to make sure we cover that thoroughly. So we're going to do an 80-room hotel at $100,000 a key. So it's an $8 million project, presumably a 75% loan to value ratio on that. We can get $6 million in debt, and we need $2 million in equity. So the question then is, where do we look for that $2 million? And where do we look for that $6 million? And how does that look? And anybody can jump in and answer that question if they want.
Well, I can start with that. So first of all, at $100,000 a key, you're looking for an existing asset, maybe with a property improvement plan, PIP. And the 75% is a little high, but it's possible, especially I think you have 2 main sources. One is either is an SBA loan. 7(a) can go up to $5 million, but $5.5 million if you have some certain energy efficiencies. 504 loan can, banks or other financial institutions can put a senior loan in front of up to $5 million of SBA, so usually up to $10 million or possibly even more. And those are good for people who may be entering the market, but that have some business experience, and they're personally guaranteed recourse loans. Also, I would say community banks, people you might have a relationship with for a $5-6 million loan. On the equity side, probably at the beginning, you want to be working with friends and family or your own money. It's too small for an institutional investor or even most family offices that invest in larger projects. But once you can get a few deals under your belt that are successful, then that's probably how I would capitalize it.
Okay. And what do you think about the idea of crowdfunding it? Let's say, I said it's an $8 million deal, right? But somewhere between $8 and $12 million deal, because you kind of put that out there. So let's say you put in $200,000 of your own capital. Okay. What do you think about crowdfunding the rest of it?
I know people who have done crowdfunding, and it is certainly something. There's companies that
I don't know that everybody knows what crowdfunding is. Maybe you can expand.
What they're basically, the world today is, over the last 5 to 10 years has become an area where there's people who weren't exposed to investment that can now invest. They've relaxed securities laws so that you don't need to register. There's companies that specialize in raising this money, for products. There's companies that will, you put it out and individual people can make an investment, sometimes as little as $5,000 or $10,000 or $25,000, and sometimes more. So for a couple $1 million, that certainly is an area. In the old school days when we were doing it, you go to your lawyers, your accountants, your friends of friends and say, here's my idea. Here's how we're going to do it. Everybody investor generally wants to see you putting in some of your own capital. Lenders like it also. They call it skin in the game. So if you put in at least 10%, then you're more likely to attract other capital and bank debt.
Right.
But what I could add to it, Mitch, with your experience, I think you've covered everything. But I think it's important, especially for those who are starting off, that you actually fundraise before your project. So I've heard a lot of panels talk about get to know your brand, get to understand how the hotel is operated. The way I would approach it if I were new is that I would have my investment thesis, understand where I want to go, understand what my strengths are. So there are 4 things I consider, 4 buckets, so to speak, when you're fundraising. The first one is always, who am I? The investor is investing in you. So a lot of times I see a lot of decks and a lot of projects, and sometimes I have to pull that out of them. They don't tell me enough of their strengths. They don't anticipate. You have to think, if you're running a project, things will go wrong. What you should think about is, in your current role or in your past experience, how did you manage situations like that? And you bring that out so you can explain that to investors. So you have to spend a lot of time actually fundraising before you get the project. I always advise that, Mitch.
Let me ask you a question. This is a nuanced question there. So we haven't identified the specific project at that point in time.
Yep.
So I know we're selling an idea, and it's all, it's not a pool. We're not doing multiple investments, but it's almost like a blind pool, if you will, because we don't really know. So nobody's really, oh, sure, I'll do that. Great. What?
Yeah.
How do you, the key here is how you present that it's compelling and will be taken seriously.
Yeah. So you have to come up with an investment thesis. All right. So if you think, for instance, Kendra, I don't know if I got her name right. She acquired her first hotel, and she was able to onboard a brand and increase RevPAR and increase ADR. You must have a thesis. You can't, you should, that's the first thing you should start with. Am I going to acquire a hotel to increase revenue, or am I going to go after a boutique hotel because I love historic hotels, or I love historic buildings, and I can get a developer who can work with me, and I can look at tax credits. It comes from, and then it must align with your vision, because I think looking at one asset, yes, it's good, but I think you're more convincing if you have a thesis behind you and you're programmatic. So even though you can source one asset, it's in your neighborhood, it should align with what you want to achieve as well. So there is a way to do it, and it aligns with your visions and your investment thesis. You have to have enough knowledge as to what exists, the trends in hospitality. If you think there's a trend with extended stay caused by COVID, for instance, I know particularly a hotel owner converted his hotel with part extended stay and part short-term stay and daily stay. So he blended 9 floors, right? So that's different. You could think about that. You could change the business plan. You can join with a hotel owner, come up with a business plan. There are 2 young guys with technology. You can approach a hotel owner with the technology, get ownership, show your track record of understanding. That's another thing too. Try to be an investor with someone else first. So you show that track record of understanding the hotel ownership. So there's a lot of nuances, but
Absolutely.
Yeah.
So, okay. So
Could I add
say
to
that?
that?
yeah, of course.
First of all, I think Sherina's making an excellent point.
Yeah.
You really need to understand why you're doing this, what your expertise is, why you want to invest, and if you want to invest, why investors should invest with you. But a lot of people say that they want to be a real estate developer or a hotel developer. And I tell everybody there's really 4 main disciplines in any deal. One is your business, legal. What's the zoning? What are your contracts? Your negotiation with brands, et cetera, management companies. What are you giving them? Second is my business, finance. What's the debt? What's the equity? What's the, do you have prepayment penalties? Are you going to hold it for 1 or 3 years, or are you going to keep it for 10 years? How do you get your investment? One is actually construction, architecture, development. What do you do with the asset? Value engineering. How do you bring the costs in correctly? How do you manage it and give a great product at the right price for materials that are going to last? And the last thing is marketing. What's your brand? Who's your market? Who's staying there? What are your rents? What are your rates at hotels? Are you going to sell, if it's a condo, you're going to sell units on hotels? A lot of people are selling branded units. And in my opinion, you should be an expert in one of those. And if you are, you can either bring in partners or you can hire the others. If you're not an expert on any of those, we're probably not interested in investing.
Right. I'd actually add to that. Well, first of all, the scenario you painted with $100,000 a key and 75% LTV, I'm in. Just tell me what city that is. That's a very pleasant scenario to engage in. But more realistically, you're going to have lower leverage, and the real lift, in my opinion, for someone coming to an asset like that, which is a introductory type of investment for a new hotel owner, is being able to synthesize a lot of information, right? The financials, the marketing, the operations, your thoughts about the zoning, the legal, et cetera, into a concise document. I think the first thing you have to do is have a plan of attack on how you're going to be able to convey all this information to investors and stakeholders and lenders in a concise manner. And so you should be able to put together a prospectus, right? Is anyone familiar with the prospectus? They exist. You can look at other ones and just think about how you're going to formulate all the data for your investment into that concise document. You should be familiar.
You're legally required to do so as well.
Right. But you should be familiar so that when the opportunity presents itself, you can engage immediately and in a short amount of time have a document done that incorporates all that information. And that's how you can convey to potential lenders and investors what the opportunity is. And someone mentioned, using friends and family money. That is absolutely, for this type of asset class, probably the only way you're going to get equity raised, because it's too small to attract institutional investment. But having that prospectus together will increase the odds of gaining friends and family investment, because folks might like you. You may have had general loose conversations about, hey, I want to get into real estate. I want to be, a hotel owner. But until you have a way to represent the opportunity, the risk, the investment, and everything an investor will be looking at, no one's really going to take you seriously, right? Because it's their money, it's their personal money. So being able to put a prospectus together quickly is super important. With respect to, for raising equity, but with respect to debt capital, I think you have to also open yourself up to debt funds. And part of the reason is SBA loans are great, and even banks, regional banks, community banks are great. Their process takes longer. They have very formulaic, sometimes processes that just drag out. They have to get several levels of committee approvals. There's time frames that exist between that. It could take you 90, 120 days, even longer, to get a commitment on debt. A debt fund is going to move a lot quicker. The cost of capital is going to be a little bit more expensive, but it gives you an opportunity to actually acquire an asset, get it under site control, at least in contract, while you continue to complete all your due diligence. Because oftentimes, if you're buying an asset and you think it's interesting, guess what? Other people do too. And when that seller is evaluating offers and you're saying, hey, I need 6 months, versus someone else who says, I'm gonna sign a contract, we're going hard in 70 days or 60 days, they're gonna win the deal. So being able to have some relationships with debt funds who you may just know tangentially, you may meet them at conferences, you might encounter them in other places. And so there's a Rolodex of a half a dozen people you can call, and you can give them your prospectus, have them evaluated quickly. At the same time, your equity investors are evaluating the investment. Is a good path to raising capital.
So I want to touch on two things there. The prospectus. So when I said to fundraise before, you can't fundraise on a deal because that's against the SEC.
You can, I'm sorry?
You can't, it's like knowing about, you're going to list on a stock, you're not supposed to know the market. So you can't fundraise on a deal before the prospectus, right? So what I'm suggesting, and this is what has been successful, is that when I say fundraise, you fundraise on the investment thesis, what you're going to do. So it's a soft market read. Because when people issue LOIs, one of the things Keith told me, you have to be sensitive about the market. He just mentioned about the environment for LP money is completely different now. So there's a cycle for fundraising which people underestimate, and they give out LOIs and they're not able to raise the funds in time. And it's a timeline factor. You have to be sensitive of the environment. So Craig is correct that you could go to family and friends, but even for 2 million people do syndication, and it's non-family and friends, and they have to have the perspective. That's the part that I'm talking about. That's when you do that sort of soft circle with a, this is what I want to do kind of thing, but you can't sell a deal before you have the perspective. So I wanted to make sure I add that in.
Right, right, that's
Yeah.
absolutely correct. Yeah. You have to have the perspectives.
Yeah.
To close a subscription agreement.
Yeah.
Yes, yeah. So well, just has anybody ever tried to, and I've done this, so maybe I'm the only one who's tried, and successfully. So we're raising, say, $2 million, $3, $4, $5 million, not a huge raise, obviously. So it's not going to be institutional, but there may be others who we can joint venture with. So someone else can do a syndication of their own of $500,000 to $1 million, $500,000 to $1 million, and we do the rest. We do another portion. Maybe there's a couple of people who do that sort of thing, and so then they coalesce together, and we end up with whatever the total aggregate equity that's needed is.
Yeah.
Does anybody have any experience with anything of that sort?
I mean, we've done that in a previous company I worked for. There were several opportunities that even as a management company, we wanted to pursue from an ownership perspective. And so we would start internally, we would raise money inside our company, and then we'd go out to friends and family. And then we found that there was a handful of our investors who would then go out and syndicate their piece and bring in other, like their friends and family. And so we would wind up at the end of the day being able to acquire or generate enough equity to go out and do that deal.
Exactly.
Yeah.
So, I mean, look, it's not easy. And like, I think if you listen to everything that has been mentioned already on stage, like there is a lot of steps and a lot of stuff that you have to go through from a diligence perspective to get there.
Is there anything easy about raising equity capital?
There's nothing easy about raising.
Thank you.
I didn't want to say that.
I mean, I'll say that. Everyone up here doesn't want me to say it, but I think it's very difficult right now to raise equity. I think, it's an interesting
As opposed
balance.
to another year?
No, I mean, I think in the past, there's been times where it was easier to raise money. I mean, today, the first question the lender asks you is how much money have you raised? And then your equity partners are asking, do you have the debt lined up for us to do this project, right? So you're just like chasing your tail half the time, trying to figure it out. So
I got a couple of comments. I mean, first of all, for example, our company just closed this week on a preferred equity transaction on a hotel. We have a second one that's closing with the same borrower in the next a month or so. Just from a timing standpoint, there's a lot of times, again, the first mortgage might be 60 or 65 or 70%, and that the equity capital right now, especially for new construction, is very difficult because a lot of investors, family offices, institutions, even individual investors, think they can get the yield that they used to try and get for equity for a preferred piece, whether it's called mezzanine or whether it's called preferred equity. So there's a lot of funds and individuals that will go up to 80%, 85%. And then instead of having, let's say it's a $20 million deal and 30% is $6 million, that's a lot of equity. If you get back to 15%, which is $3 million, it's a lot easier. Sometimes management companies will put in some investment, key money, sometimes brands will, so you could even whittle that down. So I think that's an area that is more prevalent today. There's a lot of money out there, debt funds, equity investors they don't want to take the last dollar risk. Right. They want the sponsor to take that last dollar risk. But they, instead of a financial institution that might go to 65 or 75%, they very well may go to 80 or 85%.
Yeah.
We're doing a lot of deals like that.
Right.
the one thing I'd caution on that though is on like key money from either the brand or the manager typically comes in after your project is either acquired or developed. right? And so you still need to find that money up front. You can count on it afterward. But again, like
yeah, well, yes, but a lender or
Sometimes.
it's going to in the budget. There's going to be money for working capital set aside, and so if you can just kind of slate that key money for that working capital when it comes in, typically.
sometimes. Again, all I'm saying is that you have to kind of think about that, right? Like even if the brand's giving you $1 million, you're giving it to you after your project opens.
Yeah, I realize. Yeah.
The sponsor may have to step up and
Right.
post some money up front, knowing that they're going to get some money behind. Also, if there's cost overruns and other things. So, go get your checkbook and look at your other assets and find some money and put your deal together.
Right. Absolutely. All right.
I think it's also important to show that you anticipate events. So when you're fundraising, for instance, and you talk about how you treat with risk mitigants, and how you respect reserves and things like that. And also you should stress test who you're speaking to as well, because when you're in a deal, you can have reserves with your debt funders, for instance. So you can have reserves for your FF&E. But what if the debt environment has changed? It's the equity investors you have to go to. And you should stress test that if you can make capital calls to them as well. Kendra spoke about this, understand their liquidity as well. So while you're selling yourselves, they should be selling to you too, right? You should vet them almost, is what I want to see.
All right. Let's take our next example. Let's move on a little bit. So the next example was we do a 150-room hotel, $300,000 a key, $45 million project. Debt is, I've said 75%, but I recognize that might be a little heavy. So $30 million in debt, $15 million in equity, and sort of a mid-scale project, I guess, or upper mid-scale, maybe even depending upon the market that it's in. So what are our debt and or equity sources for that? And they are different than what we were just talking about. And what does that deal look like? And so let's start at that end and we'll work our way this way.
So now you're getting into more of a conventional deal that can access the capital markets and institutional capital partners. You're gonna probably be 65% leverage max on that deal. So let's say it's, you have a $18 million equity check to raise. Neil mentioned it, and I think it's a very smart option, is to start to really optimize the capital stack, right? If you're putting in that much equity, you could be challenged with meeting a certain multiple or IRR objective. And the way to address that is to find pref equity or mezzanine lenders. So if your senior lender goes to 65% LTV, and you have to put up an $18 million check, well, you want to go access, but senior lender, they're gonna be, they're gonna price their debt at SOFR plus 500. So you're gonna be a 9% rate. The next level of
even on an existing asset, or is it
new
development?
Well, I'm talking about new construction. On an existing asset, you're going to do a little bit better.
Yeah.
Okay, but your pref equity guy is going to be low to mid-teens, right? And that's so you'd rather pay low to mid-teens on that next 5 to 10 million than give up, a big chunk of the equity, right? If you're convinced that the asset is going to perform, you have your senior debt, you have your pref equity or mezzanine capital, and you can really reduce the amount of LP equity in the deal. And doing that allows the LP equity to generate a higher IRR and a higher multiple, which your investor is going to appreciate, because if you're not meeting their investment objectives, they're not going to invest, right? So you have to do some level of financial engineering.
So let me ask you a question, Craig. So if we have a blended rate here, we have 10 million at say 12% or 13%, something like that. And we have, what was it, $30 million or something?
Senior.
It's a senior. at 9%. So we have that blended rate on that. Can we still generate enough flow and back-end waterfall to get what historically, quote unquote, historically, has been a sort of a 20% IRR, let's say, on the deal? Can we accomplish that in today's world?
Well, you have to be able to underwrite the deal and make sure that it pencils, right? And that's the complexity in this world today in investing capital into projects and making sure that for every stakeholder and capital partner, whether it's your senior lender, your preferred equity, or your LP equity, you're meeting their return targets. And it requires a lot of engineering, creativity. You have to, you're going back and forth.
Well, that's the question. Can we do that? That's what I'm trying to figure out.
Yes, you can, but that's where the skill as a good operator and developer comes in. You may, for instance, say, hey, we're close, but we're not there. I need to approach this city and get a tax abatement for the next, or get a pilot, so that my taxes are significantly reduced for this next decade. My NOI goes up and I can actually deliver the returns that my capital partners require. It may be soft money. You may be able to get some type of grant, because when you're doing these deals, and oftentimes a municipality looks at it differently than how you look at it. You are as an owner and a capitalist doing it for financial return. A municipality will say, you know what, we want to keep our people working, right? We care about the employment tax revenue. We care about the sales tax revenue.
And the TOT.
We care about all the other tax, right? All the taxes we're getting. So it's worth it to us because we're a municipality and we have a budget of, $1 billion of taxes every year that comes in. It's worth it to us to put in your capital stack to give you $1.5 million grant to help reduce your LP equity requirement, so that you keep all that, your asset stays in place. All those tax streams, all those revenue streams going to the city, it's worth it to them over the long run. So there's a lot of engineering that can be done within the capital stack to make it pencil, because I think over the past few years, underwriting has gotten tougher from equity investors, from lenders. We see a lot of pressure on the 10-year right now. Interest rates are not going to be going down anytime soon. And so the cheap debt play is over, and you have to be able to do some engineering or figure out some ways to do some significant operational improvements over time to generate the returns.
Yeah, I mean, I think engineering is the right word, to be honest. I mean, I think when you look at that deal that we're talking about, that $45 million deal, $30 million, you're probably talking to like regional banks or credit unions. We worked on a few of those where the seniors now bringing in like C-PACE lending and taking a piece of that to help, kind of compress the rate, at least on the senior. But when you're underwriting in an environment with like modest gains in RevPAR, I mean, there has to be other levers you can pull in order to make that deal work.
Just to digress for a moment, explain what C-PACE is for people in the audience.
Yeah, I'm not the best person to explain it.
We
use it, but I let Neil explain it.
All right, so C-PACE is it's actually been pretty good for hotel, either new construction or major renovations. It's a program that the government approved to help encourage energy efficiency, new windows, energy efficient roofing, HVAC systems, et cetera. Usually it corresponds to 20 to 25% of a total budget on a new construction. So if you're doing a $45 million deal, it's probably, $9 or $10 million. And that money, the rates are decent, usually around 6 or 7%. So a little more than a senior permanent loan, but for a construction loan, or reduces the amount of construction. A lot of lenders do not like C-PACE because it actually is in front of the senior loan. It basically is your tax bill. The good news is it's amortized over usually 25 years. So and you can pay it off if you achieve your objectives. If your income's there. But one of the other thing that I think that you should look at on this $45 million deal, the question is that new construction, great points about cities helping with grants or TIF funds or pilot, which is a way of getting money in lieu of taxes. But if it's an older asset, 50 years old or longer, one thing to really look at is historic tax credits.
Yeah.
We've done a lot of deals with historic tax credits. That could be 20% of your construction costs, and including soft costs and developer fee. So again, if you have a $45 million deal, and let's say $35 million, not including land FF&E, qualifies for historic tax credits, you could get $7 million of money, and that could be in the lieu of equity.
Right.
So now if you have 45 million, let's say you have 25 or $30 million of, call it $30 million of senior debt, and now you have $7 million of historic tax credits. Instead of 15 million, you only need $8 million.
So let me, you and
did
I,
wanna
maybe,
add
let me just ask, him
That's much cheaper than pref equity. It's much.
Well, it's free.
Yeah, it's almost free. I mean,
So you know what really sucks, Neil? When you're trying to do an historic tax credit deal on a building that was built in your lifetime.
I did.
I'm with you there.
Yeah, I did want to add to, Craig, you did exactly what I would do. You break it down. There are two things I want to add. Coming back to the blended returns. So I would really go off market. Some of the panel members spoke about that. In this environment, I know a colleague of mine, she's spending months getting to know owners in certain areas, speaking to them, and trying to get at a high cap rate. You come in at a higher cap rate, buy at a discount. Then when you exit, with all the reasonable assumption on your exit cap rate, that's how you get your internal rate of return higher, right? So that's one thing I wanted to add to the mix. And then the second thing is, previously it was a project under construction that you would get the higher internal rate of returns. Acquisition and repositioning and value add opportunistic, it wouldn't exceed really construction. But based on the supply chain, increased cost, etc., look at alternatives when you're doing construction, like the brickless technology, the modulus, the technologies. Look at, taking on sustainable, like solar panels. You have these firms that will do some of your, some of your procurement and fund it as well. So there's other things that.
I'm trying to keep this conversation to just acquisition assets as opposed to new development, though. But so let's shift gears for a little bit. And Keith, you may have some experience with this. So there's a lot of REO opportunities in the marketplace right now. And I think that they provide kind of excellent seller financing because the bank that's owning it, they're tired of owning it. They just want to have a good loan on it, right? So what does a deal like that look like?
You still have to get the equity.
Yeah, it seems simple, but it's
$45 million.
Yeah.
Okay, it could be any of those, but I just shifted gears a little bit.
Look, first and foremost, you have to have a lot of those projects come back to the bank because they have issues to begin with, right? And so I think you really need to dig into those type of projects and figure out if it's a project that can work or why didn't it work initially, right? Whether it's the cap stack was wrong, or it's the market has moved away from that asset, or it's the wrong brand, or it has been capital deprived. So I think you have to look at that first to make sure that there's actually a business plan or a path to actually make the deal work. And then you have to have a lender who's willing to actually take a haircut and actually sell it. So I think for the last number of years, every time there's this mention of distress in the market, everyone's excited about all these opportunities that are going to come to fruition,
And they don't.
and they don't, right? Everyone raises these debt funds and distress funds, and they're all loaded up with capital and they're all waiting for it to hit, and it hasn't necessarily materialized. Even if you go back and look at 2007 and 2008, it hasn't really happened.
Let's assume for a moment.
Some of it.
Yeah,
but again, I don't think the wave that everyone was expecting of distress actually came to the market.
Hey, can I offer an example?
Sure.
It's a little bit more than 45 million. So
Yeah.
the hotel that we bought in New Orleans. It was a Fairmont hotel. There were actually 700 rooms, but 150 were leased, which we ultimately didn't take on. There was an event in 2005 called Hurricane Katrina. It devastated New Orleans, parts of Mississippi, Alabama. New Orleans, the levee broke, the water came in, all of downtown. New Orleans was flooded. This was a historic hotel. First phase was built in 1907. The second phase was built in 1926. It was a wonderful historic hotel. The owners were very substantial international owners and investors, but they weren't necessarily developers. And when they the rehab costs looked like it was to be 10, 20 million, they were interested. At 30 million, they were on the fence. At 40, 50 million, they said, we need to sell this asset. I found out about it through a friend, put together a letter of intent, brought in a partner who was a hotel manager and developer at 50 hotels that we'd financed before. We put the deal together. We bought an asset that replacement cost would have been $150, $200 million for $20 million, including a bunch of FF&E that they had bought, new carpets and things that when they were going to renovate it. Ultimately, we spent $165 million, but there was historic tax credits and there was a bonus because of the Gulf Opportunity Zone legislation. We got new market tax credits. We got a tax freeze from the government for 10 years fixing the real estate taxes. So that $165 million really cost us about $90 million. We got about $75 million of subsidies. So that was a deal that was REO, but our deal buying it for $20 million, we let the seller keep the insurance proceeds. So I don't know how much that was. Was it 50 million, 60 million? So they were able to pay off their debt and did not deal with the asset. They didn't know about tax credits like I did. And we still own the investment. We make money every year. If you want to stay there, give me a call.
I'm going to be doing that, actually. Yeah.
It's a beautiful asset. Was this year named the #1 city hotel in New Orleans. It's been named one of the top Waldorf Astorias in the system by Hilton. So come to New Orleans.
But you changed flags.
We changed flags. It was a Fairmont.
Yeah, yeah.
We were actually, I think, the third Waldorf Astoria when Hilton they owned the Waldorf Astoria Hotel in New York. They said, this hotel has got more name recognition around the world than the St. Regis or Ritz-Carlton. So let's create a brand. So they did. Now there's probably 50 around the world.
Yeah.
We were the third one. We were able to convince
Right.
Hilton to put us in the system.
Right. Very good. Yeah. So Keith, just to comment on what you were saying, so the lender's not really taking a haircut though, because the lender, let's say they were in at 65% or whatever in the foreclosure process, the REO, as long as you pay them whatever the principal amount of their loan is, they're out. They're not going to get hurt, I would say.
I mean, that's in the perfect world, but generally, an asset in that situation, they're not being made whole.
Okay.
At least, again, that's just my opinion.
Okay. No,
or at
that's
least
fair
my
enough.
experience. I mean, I don't usually disagree.
No, I agree. I think lenders will take hits and they'll try to move a non-performing asset off the books. They literally
Absolutely.
have to because it affects their capital ratios and impedes their ability to do future business. What I've seen in distress scenarios is a very aggressive and active asset management capabilities at lenders, and they really try to identify assets before they get distressed. And then you're dealing with an asset management team, you're on a watch list, and they're very concerned about these types of occurrences. But I do think a lot of lenders do take discounts eventually because it just impacts their mainline business too much to keep a non-performing asset on the books.
Lenders are generally horrible at owning real estate.
Yes,
Yeah.
agreed. Okay, so let's focus for a moment on, in this deal, this $45 million deal, the $18 million equity check, there are different sources for that capital. So let's try and, inform the audience as to where they might look and how they go about looking and engaging those prospects and developing the credibility that ultimately will result in hopefully.
Yeah, typically,
engagement.
if you're looking at an existing asset with existing cash flow, you're talking probably about a good brand, a good location. Maybe you're going to improve the cash flow as an operator by doing some things, cutting costs, raising rates, et cetera. But it's a stable institutional quality asset. So there's a lot of funds, insurance companies, pension funds, sovereign pension funds internationally, state and city pension funds that will invest in this asset with a qualified sponsor. So you want to bring in, usually you're going to own you'll have at least 10 hotels if you're going to be doing this $45 million deal, or you're going to partner with somebody that owns those hotels and there are funds that actually invest. A lot of times the institution will put out, let's say 45 million, and let's say you've got a $30 million debt and 15 million of equity, 15 to 20 million of equity. You would have the institution put up about 90%, 80 to 90%, 12, 13, 14 million.
Yeah.
And then the sponsor only has to come up with $1, $2, $3 million. And sometimes there's funds that will co-invest with that sponsor and put up most of that money. So the sponsor may, if they have the track record, they may be able to come up with a joint venture partner who their internal rate of return, instead of being 20%, might be 12%. They might be happy getting 6% or 8% up
And a pref.
and a pref. And then there's something called a waterfall where, you start off with 10% and then you get management fees, and over a certain return, maybe you get 20%, 30%,
Okay.
40% of the upside after they've achieved a certain level.
Okay.
I'm going to use a karate analogy. Neil is over there. He's a third-degree black belt. In the way he's going through the nuances of creating a capital stack, I think what would be helpful for the audience is to actually look at some deals, like spend some time investigating how deals are done. Look at transactions. Look at you could see them in the paper all day if you pick up a trade journal in your city or the Wall Street Journal, whatever it is. You'll be able to see transactions. Investigate it, because there's a lot of creativity that goes into cultivating this capital stack. And when you're curating this capital stack, you've heard of CPACE, you've heard of historic tax credits, you've heard of pref equity, contributions to municipalities, TIFs, pilots. There's a huge toolkit available to you. It's like, you are the author of the next chapter in this asset, in the life of this asset, and you get to create the structure for how this asset is going to be financed and put into service. But it does get involved. The people on the stage are very fluid and experienced at it. But if you guys are serious about it, study a few transactions, learn how to put that prospectus together, understand some of these tools that are available to you in curating the capital stack, and talk to people, create relationships, because a lender or an investor is going to like someone who's been talking to them for a year, will understand your sincere, authentic interest in the business, in the deals, and can feels like there's a conversation and a dialogue already happening.
Mitch, I just
I think
want to
that's
add.
great. I think that's great advice, by the way. And before, I want to make sure, are there any questions in the audience? Since we're running short on time, there are some questions. That gentleman had his hand up first, then Althea. Speak loudly, please.
This is to Sherina. There was 4 items that she was mentioning, and I think she only got the first one, so she could get to 3.
The same question?
One, say, who am I? That was your first one.
Yeah, person, project, financials, and partners. Because I know we're out of time. Project, all the good things that you learned in this conference, location, it comes to mind. Everything about the look, you got it, right? So it's a person, project, the financials. So One of the things I learned on this in this conference, for instance, Bridgewater or Bridge, the Ahoaga, yeah, Bridge.
Yeah.
They give you a free tool. So if you want to acquire, you've seen a hotel that you want to acquire, use that free tool, get the pro forma. But then when I talked about the financial returns, you have to present the pro forma. So you should deep dive and understand all the assumptions behind it. And then with partners, talk to all the brands, talk to your operators as well, because most likely this is your first or second acquisition. You are not a known operator, so I would advise to talk to operators, get some very solid names. One thing that I didn't hear touched on in the conference so
I
far,
want to get another question in. So
yeah, just quickly, this is important though, is that you show that you can report to investors. Show your governance and the structures that you're going to put in place and how frequent you're going to report to them, because that's very frustrating as well. When investors, you don't have a regiment of how you report to them.
okay, it's good details. Althea.
Two quick questions, please. One, how does a syndicated investor get into this mix? And then two, what's the open door? Or what is the door? Oh, thank you. Thank you. What is the open door or the door to open to and the process to put together the stack, right? It seems like chicken and egg. I mean, when I came in, you were talking about the lender wants to see this and the investor wants to see that, but each one wants to see it first. So how does a person put together their deal?
First
Just
of all,
steps.
I think this is maybe an answer to another question, but that corresponds here as well. When we talk about, when Craig talks about knowing all of this information and all of these different tools that you have, and it's very sophisticated, most people in this audience, most people in the world are not going to be experts in all of this. So you're going to have to talk to some professionals that really know what they're doing. On the finance side, I'm a professional. Sherina is a professional. We know all of these things and how to mix and match and what's available. Mitch is a professional. Talk to a lawyer that knows, they know people like us, but they know the law. They know what municipalities can do. They know the documents. Talk to the brands, and they may have capital. They may know how to get money out of different brands, et cetera. So don't do it alone. Again, as I started out, if you're an expert in one or very knowledgeable, you can bring on some other people that can help. But everybody is not going to know CPACE and different kinds of tax credits and TIFs and pilots and all of that.
That being said, Althea, I agree with what Sherina said, that you have to, if you will, pre-market or pre-qualify your deal through documenting your investment thesis and engaging in conversation. And you won't get a commitment until you have a specific deal with a specific projected IRR that you can present. But all of that takes time, and people have to get comfortable. And the number, I've said this earlier to students earlier this morning, the number one thing you have is your integrity and your character. And so they're investing in you, as Sherina said. And so
Mitch, I'd add experience to that. Have you done it before? Have you done an asset like this? Have you taken a historic thing? Have you turned something around? Have you invested in this market? Have you reduced costs and increased NOI? And if you haven't, do you have a partner on your team that's done it? Because if you don't have those,
I agree with that too. Yes.
Yeah, I mean, integrity, et cetera, is good, but if you haven't done it, then it's hard to find investors.
Yep. So we're sort of out of time. I'm sorry that we are, because it's a good conversation and we could have kept going, but
All good things come to an end.
I want to thank you for all attending and today and the whole time. And thank our panelists. Terrific conversation. Thank you.
That was Capital Forum, funding the deal, looking for capital, how to find equity or debt, and why would an investor or joint venture partner fund a project. That was your moderator. Thank you, Mitch Miller, attorney and CEO of Miller Law Firm. Our panelists, Craig Livingston, managing partner of Exact Capital Group, Neil Freeman, principal from Aries Capital, Keith Oltchick, chief development officer from Remington Hotels, and Sherina Hosein, principal of PSGN Capital Partners.
Great question.